Hello fellow investor, if you trade option or if you invest using option in any way, you are probably familiar with the wheel strategy. It's one of the most popular and common option strategy out there. There are tons of videos on YouTube or people on Twitter saying that they make million with the wheel strategy. That guess what, this is not always the case. So I decided to do my own video on the wheel strategy. I will explain how does it work, but at first I will understand if this is the correct strategy for you. I will then explain how the strategy works. I will make a simulation with a stock, and using the chart we will understand when to sell the cash secured put, when to sell the covered call, and so on. And at the end I will switch to my interactive broker account where I show you how I choose stocks or ETF to start this wheel strategy in order to maximize the premium, but at the same time to keep the risk as low as possible. As usual, everything is in the timestamps, so let's start to understand if you should run or not the wheel strategy. Everybody of course can run the wheel strategy, but in my experience I found out that only some type of investor can get real advantage of that. So I decided to make a small list of features or characteristics that you should have it in order, in my opinion, to take advantage of this strategy. First of all, you don't need a margin account. It's enough to have a cash account with your stockbroker in order to run the wheel strategy. Of course, due to the fact you are using cash secured put and covered calls, if you don't know, please check my video right here and check also the link into the description, because you need to be familiar a bit with the concept of cash secured put and covered call. Anyway, you need enough money, enough cash available in the broker in case you get exercised when you sell the cash secured puts. How much money? It strongly depends on which kind of stock or ETF you are choosing. We will discuss this a little bit later in the video. But anyway, no worries, you are not using margin, you don't need the margin. The second and most important point, you need to be bullish about the stock or the ETF you are going to choose to run the strategy. The wheel strategy need to be run on a span of 6 months, 1 year, and so on. So you need to think about your investment long term. And you need to choose a stock or an ETF that you are bullish on. You don't need to panic when the stock price go down. For this reason, you need to choose a stock that you are very confident in. Because if for some reason you get assigned to the cash secured puts, you will own the stock. And while you are selling the covered calls, you will keep owning the stock and the price can probably go down. For some reason you choose a stock just because it has an high premium, but you really don't like the company, then you will have trouble when the price go down. You will be scared, you will chicken out, and you will sell your stock. Guarantee 100%. So choose only a stock or an ETF that you are 100% bullish on for long term. Another important point is your needs of income. When you run the wheel strategy, you will receive a lot of income as a premium, but this can affect the long-term capital gain you can have when you will sell the stock. Monthly income or weekly income, whatever it will be, need to be more important than the long-term capital gain. If you are in the investing only for the long-term capital gain, forget about the wheel strategy. Just buy the stock or the ETF, close your eyes and wait 1, 2, 10 years, whatever it is your span of investment time, and get your capital gain at the end. But if you, like me, like to receive income from time to time and you are ready to sacrifice a little bit what will be the capital gain at the end, then the wheel strategy can work for you. But it will work for you only if you are able to keep your emotion aside. Running a wheel strategy long term will translate in a lot of time where you will feel frustrated and you think that it was much better not to run the strategy but just to own the stock. This is normal, it happened to everybody, but you need to be a little bit cold-blooded in order not to follow this emotion and to sell or to buy the stock, but just to stick to your strategy and follow the pattern that you decided at the beginning. If you arrived at this point of the video without closing it yet, you understand everything I said up to now, most probably you are a good candidate to run the wheel strategy on your stocks or on your portfolio. So let me explain how everything works. With this chart right here, there is everything you need to know if you want to master the wheel strategy. It can look a bit complicated, but don't worry, I will explain step by step. First of all, you need to start without owning any stock. You don't need to own the stock or the ETF you need to use for the wheel strategy. You start with zero, with nothing in your stockbroker. First step is this one, to sell the put option. Basically, sell a cash secured puts. I said before, if you want to understand correctly what you are doing for the wheel strategy, you need to take a look at what are cash secured put and covered calls. If you don't know, check in the description. I make 2 different videos where I explain one and the other. So if you're not aware, please stop this video, check it that, and after come back. So first step, you sell a put option. Remember, in the wheel strategy, you always sell out of the money, also for the put and for the covered call. So you sell a put out of the money, so at lower price comparing to the correct amount in the market. Let's say you sell with expiration date of 1 month. Let's think only in the order of 1 month. After 1 month, 2 things can happen. You can get assigned. In that case, you will buy the stock, or you cannot get assigned. It means the stock price is still higher comparing to your strike price. So nothing will happen, you just collect the premium and you go again to the point 1. It means you sell another cash secured puts and so on. In the moment you get assigned, as I said before, you will buy the stock. Then you will start to sell the covered calls. You will sell covered call out of the money, so but this time means at the price which is higher comparing to the market. And the game will continue like that. You will sell it until you get assigned. If you get assigned, you will lose the stock because you will sell it, and you will start again from point 1. You will go again to sell the cash secure put. Do you think it's complicated? You think you didn't understand? Don't worry, wait a second. Let's check step by step with the chart. Let's decide to do with experiment with Tesla. Tesla is a stock that I don't like, honestly, and it's far away from the type of stock in my portfolio, but it's a stock that is very much used from option seller because the premium is quite high and it's a high beta stock. I will explain later what it means. So let's think about Tesla in this. This is the actual price of Tesla. Let's say we are at the beginning of July. As you can see, I divided this chart by months: July, August, September, and so on. Every vertical line is the end of the month. So this is the right price at the moment. We don't, as we said before in this chart, we don't know the stock. We are at this point and we start to sell a cash secure put. We sell a cash secure put, as I said, out of the money, so at the lower price comparing to the market price. You see the price is a little bit lower. Expire date 1st of August, so in 1 month ahead. And then we just wait. Let's wait, and we see that in this case the stock price went up. So we will not get assigned, because to get assigned for a cash secured put, the stock price need to end up lower comparing to your strike price. So you will just collect the premium like nothing happened. And you start it again, and now you sell another cash secured put, still out of the money, a little bit lower of the current market price. And you wait another month. In this case, for example, the stock price end up lower comparing to the cash secured put. It means you get assigned, you buy the stock, and now you own the stock. If we go back to our chart right here, we are at this point now. You got assigned, yes, now you own the stock, you need to sell the covered call. So let's go here, sorry. Now we need to sell a covered call, again out of the money. In case of the covered call, out of the money means a little bit higher comparing to the market. And this is our covered call. Expiration 1st of October, price a little bit higher comparing to the market price. And again, you wait 1 month, price is lower, you don't get assigned, you sell another covered call out of the money. Wait another month, in this case the stock price tanked, you don't get assigned, and you sell another covered call out of the money. Remember, every time you sell cash secured put or covered call, you're collecting premium, you're making money. This is the goal of the strategy. You wait another month, still the stock price is lower, you sell another covered call, and so on. This right here is a situation that is a bit terrifying. I said before at the beginning of the video that you need to be a little bit cold-blooded, because imagine in this situation, you bought Tesla right here at the cash secure put price when you got assigned, and now you own the stock that is tanked as a price, so you have a quite big unrealized loss. Yes, you are collecting a lot of premium, but you see a big red minus in your stockbroker, and this can scare you out. This is why I said no emotion, cold-blooded, stick with your strategy and invest only in stock you really believe long term. If you really believe that Tesla is a stock that you want to own long run, 5-10 years, because you think the price will go up on the long run, then doesn't matter this short downturn. But if you decide to use Tesla just because the premium is high, but you really don't believe in the company, now you are a bag holder. You find yourself with a stock that you don't like, with a big minus, and you just need to hope that the price go up, or you decide to sell and take the loss. So this is why it's super important that you believe long term in the stock. Anyway, we arrived to January. The stock price went down, so we still sell another covered call. And this time on February, the stock price skyrocketed and we got assigned. And if we go back to our chart right here, we are at this point. We got assigned, we lose the stock because we sell the stock. Now we are without any stock in our portfolio and we start from point 1. We sell another time cash secure puts. Let's go back to the slide. We sell cash secure puts out of the money, so a little bit lower like we did before. Wait another month, we don't get assigned, we sell another cash secure put. In this case we got assigned. Again, I will explain another time. You got assigned, you buy the stock, now you start selling covered call out of the money, price go down, you still keep your stock, and so on. I will not explain step by step, I will arrive here at the end. Is approximately 1 year of investment. And you see that you will switch between selling cash secure put and covered call. There will be time where you own the stock and you will see the price go down and you will panic. There will be time when you don't own the stock and you will see the price go up and you will think like, why I just didn't buy the stock instead of selling option. Yeah, this is the risk. This is how the wheel strategy will play with your emotion. But you need to remember one important thing. Every time you do a trade, you get money, you get premium, and this is why you are in this game, because you want to collect premium every month. Just another slide to show, you see this one in blue a little bit transparent. This is the real price, the real movement of the Tesla price during the same year. I just copied in red to show that this is a situation that can exactly happen. If you was investing in Tesla at the beginning of July last year, doing the wheel strategy, you will end up exactly how I explained it in this chart. Let's now jump inside my interactive broker so we can take a look of how much money you can really make with a wheel strategy and how to choose the correct stock or ETF in order to get high premium and low risk. So this right here is my dashboard, interactive broker. Remember, this is the preview of interactive broker. If you want to see the review of this new platform, you can take a look at the video right here. Let's check first of all Tesla, which is a stock I used in the previous example. Here it is. When let's open the option chain. Please remember, I'm shooting this video on Saturday, so of course the market is closed. It's possible that some of the information are not updated. And let's take, for example, 27 days strike price, just to have an idea. The first thing to do is to sell the cash secure put we saw in the video. If we sell a cash secure put, let's say with a delta of 0.2, something like that, we are talking about $440 as a premium. It's quite high premium, and the reason why the premium is so high is because Tesla is a high beta stock. What does it mean high beta? You can check, for example, in Yahoo Finance right here. Every stock, every ETFs has what is called beta, which is a way for us to understand how is the risk of each stock, how much is stock move comparing to the standard market. And as the standard market, we mean the S&P 500. A beta of 2.09 means that in average, if the market go up 1%, Tesla go up 2%. If the market go down 1%, Tesla go down 2%. This is a very volatile stock. The highest the beta, the highest will be the premium on option strategy. So for example, as we said, Tesla is a beta of 2.09. If we sell a cash secure put out of the money, this one that are in light gray, at approximately 1 month with a delta of 0.2, it came out 4.4. So it means $440 we will get as a premium, and we have approximately 80% chance not to get assigned, just to keep this premium and go on selling another cash secure put. In case we see from the other side, when we sell the covered calls, the price will be pretty much similar, because if we take a covered call with a similar delta of 0.2, in this 80% chance not to get assigned, the price is pretty much the same, 4.5, so 450. With this sort of wheel strategy on Tesla that is done each time per month, you will get in premium approximately $440 per month. which is not bad. Let's move to, for example, to another stock, to Apple, which is still a high premium, but it has a lower beta comparing to Tesla. Let's open Apple. Let's go first of all on Yahoo Finance. We see that the beta of Apple is 1.27. Comparing the beta of Tesla that was 2.09, this is much less volatile stock, and this will be reflected from the point of the premium. Let's go in the option chain. Again, let's take something around 27 days, so same approach, and let's take something that is around 0.2 of delta. You see that your premium will be $150. It will be $150 in case of selling the cash secure put, and hypothetically with a similar delta of 0.2, okay, we don't have many strike price right here, but anyway it will be 1.84, so like $180. Having the wheel strategy with Apple will return less than $200 a month when it was more than $400 with Tesla. This is not the only thing you need to check, and this is not the only reason why the premium are different. The premium are different also because the price of the stock is different. Apple is trading at approximately 178 right now, so if you want to involve an investment of 100 share of Tesla for your wheel strategy, means you need to play with around $18,000. While if we do with Tesla, sorry, I go back, which has a stock price which is a little bit higher comparing to Apple, the strike price, the actual price is 249, 250, let's say. To play with 100 share of Tesla means to have in your account, because you're not doing margin, you're doing cash account, approximately $25,000. We need to understand then that the premium is higher also because the value of the underlying share is higher. So it's pretty normal that Tesla will pay a higher premium. It has a bigger beta, it is more volatile, and also the money involved are bigger. If you're okay to get a higher risk, you can choose a stock with a high beta, but this is extremely risky. For example, let's take a look at Carvana, which is a stock I will never own in my portfolio, honestly, which has a beta of 3.09, which is much higher even than Tesla. The stock is trading only at $46, so it means the cash you need to have in the stockbroker is something less than $5,000. It's not that much, but let's check Carvana here on Interactive Broker. Let's check the chart. It's quite scaring, honestly. This is why I will not own this stock, but let's say that I'm crazy. I really believe in this company. I'm not worried about the risk. With a beta of 0.2, you can have a premium monthly between $170 to $200 with only an investment of $5,000. This is approximately the same we were getting with Apple, but Apple required $18,000 investment. There is really a lot you can do in choosing the stock for run the wheel strategy, but as I said, please don't risk too much and follow one of the first rule, that is you need really to be long-term investor and really bullish on the stock you use for the wheel strategy. Otherwise, it will be a trap for you. So I hope the video was clear and exhaustive. I hope you understood how everything works. Please, if not, if you have any question about wheel strategy, cash secure put, covered call and so on, you can drop me a comment. I always try to reply. Remember, I use the strategy together with my usual dividend investing. I'm not an option trader. My main investment journey is not related to selling or buying option, but is dividend investing and anyway long-term investing. But I found out that some option strategy can be used together with a long-term perspective. So this is why I use it time to time in order to maximize and to increase my return. Hope everything was clear. Subscribe to the channel if you didn't do yet, because it really helps a lot. And see you to the next video.